All right, guys, welcome to the channel. So in this video, I'm going to be breaking all of the myths of commercial real estate, this supposed commercial real estate crash, why there is a decrease in real estate prices and transactions, the mathematical reason behind it, and basically just break down the true way commercial real estate works versus all the bullshit that you guys see online with like all residential guys and people just looking at graphs, not actually understanding anything to do with how commercial real estate transactions get put together, yet they just want to say, oh, we're in a crash. Now, there is a reason why we might be in a crash, but I will break that down in this video. So if you guys don't know who I am, my name is Armand Violi. I'm a commercial real estate broker who's done over $100 million in transactions in the last 3 years. Did that with zero experience, got into commercial real estate. I specialize in manufactured housing communities, but these principles apply to all different types of commercial assets because ultimately they're all businesses, they make money, they get financed. It's ultimately worth what the returns are on your money invested in a deal. So with that being said, the main reason that a lot of people think commercial real estate is crashing right now, and this is a big myth, is because of graphs like this, right? So this is just a random one I found on the internet by Grandway. I don't know if this, I guess this is like some group that has. All right, they pulled CBRE data. Anyways, commercial real estate transactions right now are down for two main reasons. One, interest rates being higher, and then two, lenders tightening up and wanting increased down payments and just tighter restrictions. But the main reason is interest rates went up. Now, why does that affect commercial real estate? So unlike residential real estate, commercial real estate is based on the returns on your investment and the income of the property. So residential is based on comps. Basically, if someone's buying a house on your block, and you get an appraiser for it, they're going to look at what other parks or what other properties on the same block sold for. Okay, one sold, that's a 3-bedroom, 2-bath, similar build quality, age, and everything. They have their little formula put together, and then that's what your house is worth. Commercial real estate, it's the more net income of the property you have, the more the property is going to be worth based on market conditions like cap rates, financeability, things like that. So since interest rates went up drastically than ever before, and you could see this like with COVID when interest rates went extremely down through 2021, you could see the spike here in transactions because interest rates were down. And then since they rose interest rates drastically to combat inflation, you see transactions going down. This is Q1 2023. It's actually lower now in Q3 2023 and going into Q4. Mainly because you can't pay as much money for a property and get the same returns on your investment if the cost of debt is going to be so much. So at X amount more. So to better explain that out in simple man terms, I put together a mini spreadsheet for you guys to better explain this. So let's do this as an example. And then, one other thing I want to talk about too, before I get into this spreadsheet. All different types of commercial real estate are different. It's not like all commercial real estate is one asset class. So what I mean by that is just because an office building and office buildings nationwide might be crashing because there's decreased demand in office workers going to the office and there's more remote workers, that is not indicative of a mobile home park in Ohio outside of Columbus that is growing and there's an increasing demand for affordable housing. The same way a single family rental house in bumfuck nowhere, Michigan is not going to be the same as a single family rental house on the beach in Tampa, Florida. There's going to be different varied amounts of demand. And yes, the interest rates with banks and the financeability and the cost of labor and all those things do affect it like all types of real estate. But sometimes there just are such good markets and such growing demands in some places that regardless of these bad things on the financials, the demand overcomes the bad financials because the income is increasing at a higher rate. So like a lot of people don't understand how the math works, which I'll break down with this graph. So for this example, I'm going to show you guys, and this ties into my explanation. I'm just doing this off the cuff, so I'm speaking a little bit all over the place, is what you're really working for is two things. So there's an internal rate of return that's going to be like your total returns your total returns internalized over an entire hold period. So a bunch of cash flow, big exit on the end, divide that by however many years you held, that's your IRR. That's one major metric, but that's a lot of figuring out in the future. The really two things that go into play right now is, can you get it financed, and what are your just cash on cash returns, aka your set returns? Because we don't know where the market's kind of going unless this is a property that you have plans of like, oh, I could fill in 20 different units, raise the rents this amount. I'm assuming we have like some stabilized type set asset here. So let's say you have a $10 million property and it brings in net, like actual net. So let's say it brings in around 120K a year, or 1.2 million a year in gross income, and then 50% expenses off that. Let's say its true net is $600,000. All right. So what we're going to solve for right now is cash on cash returns. Let me explain this to you. So cash on cash returns is going to be the return on the actual money you have in the property. Everyone who buys commercial real estate buys with financing, because having to put less money down into a deal, like less, instead of buying it $10 million cash out of pocket, you only put 20 to 30% of actual cash out of pocket. You pay a little bit of debt payment, but you get to reap all of the upside benefits of the deal. So as the world inflates and the cost of everything goes up and demand goes up, because whether it's growing population or whatever in a good market, you get to capture all of the upside of a commercial real estate deal and the upside in equity growth in exchange for lower down payment, aka you'll have higher returns. So to show you how this works, let's say this was 600,000. So this would be a 6% cash on cash return technically if you just bought it out cash. And the way I'll show you that is, this should be 100. My bad, guys. So if you did, So if you did 100% down payment, aka you just paid the whole thing in cash, no bank financing, it's a 6% cap rate. Now, when you only have to put 30% down with the bank, and for the sake of this being simple for you advanced guys, forget about amortization, everything. We're going to assume everything's interest only. So let's say it's a 5-year term, 5-year interest only. So you only have to put $3 million down, and now you're paying a 5% rate on that yearly, which is $350,000 a year. Okay. Your cash on cash returns now, aka your actual returns on the money invested in the deal, $3 million, bringing in 600K minus 350K equals to whatever equates to 8.33% cash on cash returns. This is at 5% interest rate. Now, with interest rates going up, what happens to this purchase price? Let's say it goes up to 7%. We're just looking at cash on cash returns now. So with all things staying the same, 7% interest rate, now cash and cash returns have dropped all the way to 3.67%. So if we're looking at this on actual cash flow of a property day one, or just cash flow returns we're going to get on it, ignoring all these other factors of potential growth and everything. And when a market's constricting, you obviously have less optimism about where rents are going to go over the next few years, which is also another thing that's contributing. But I just want to show just pure financeability factor and returns you're going to get on your investment. Now to try and get around the same, what was this before? 8.33%, we're probably gonna have to go to, just spitballing, 8 million, a little more than 8 million, let's say 8.2, 8.1. Yeah, about. So if you guys see here, a 2% increase in the interest rate dropped our price almost 20%, aka down to 8.1 million, just to get the same cash and cash returns. Everything else stayed the same with the property. We're still making a total 600K a year net. All that happened was the interest rate went up to 5%, from 5% to 7%, and now all of a sudden your property value for the same amount of returns just dropped 2 million. Now, how does this cause a dip in the market or cause transaction volume to go down? Well, there's always a lag in the market, and where sellers do not want to accept that, hey, 6 months ago I could have got $10 million to my property and now I can't. What gives? The lag in them dropping their expectations and buyers needing to get returns on their money causes transactions to not happen, and the market needs to react and shift, which is always a delay, which is what we're seeing here. Is the market from the interest rate rise is reacting and shifting, and the expectations from sellers has not come down to reality yet, which is why you're seeing a lack of commercial transactions. And now this is bottoming out now because rates have stabilized right around anywhere from 7 to 7.5%. It's kind of stable there, went up a little bit, then it came back down. So we're in kind of a normalcy where we're not going 50 basis points, 0.5% in the interest rate every few months. But that's one way that the interest rate rise affects commercial real estate, and what is causing what people think is some commercial real estate crash. And no, it's just correcting to the market because you cannot pay the same amount of money and get the same returns when the cost of debt is higher. Now let me do another example. So let's go back to our original 10 million. And let's ignore now cash and cash returns, and let's focus on debt service coverage ratio. Okay? So debt service coverage ratio is whatever the cost of your debt is per year, your net operating income, you pay it monthly, but everyone analyzes deals on a yearly income basis because you sign year rents, things like that. So whatever your debt payment is going to be, the actual cash flow of the property after the debt needs to be 1.25x or 1.25 times the what do you call it, the debt payment of the property. So that means if you have a $100,000 debt payment, you need to be making $125,000 a year in net cash flow at a minimum for the bank to lend on that property. And this is the minimum requirement. So I'm just going to set this to the minimum requirement. But basically the reason for this is the bank wants to see there's some type of spread between what you have to pay them each month and your ability to cash flow on top of that. So if there's any fluctuations, they're still safe enough to think, hey, this guy can still pay me, which is why they want you to be 25% above whatever they're charging you per month. So let's talk about this now. We're going to ignore cash on cash returns. I'm going to hide. I'm just going to delete this because I want to make it simple for you guys. So debt service coverage, it's going to be equal to your NOI. Well, basically, it's going to be your fucking NOI divided by principal. We're going to do principal and interest this time instead of interest only. So we'll make it simple. So let's get rid of this. So now we're not interest only, guys. Forget about this balance payoff at the end. And I will talk about where there could be a potential crash, and I'll explain that more now. And that's going to be a major correction rather than this is just the markets reacting to changes in the debt markets. But I'll explain a little bit at the end of this how there is potentially some type of crash. So you can see here that this debt service coverage, aka the cash flow of the property, is covering this debt payment at a ratio of 1.32. Now let's change this purchase price to account for that. I'm going to get this to exactly 1.25x just to show you that this is the max a lender at these rates, 5% interest rate, 30% down, 30-year amortization would actually finance on this. I'm going to guess this is around the dot. Yes, I am correct. Simple math. So 1.25x. Now let's watch what happens if the rate goes up to 7% from 5% again. Boom. Now it is not covering debt service. It is below the minimum 1.25x threshold, which means a bank will not finance this property anymore at $10.5 million. What they'll finance it for, and I'm just going to spitball again, let's go with 8.1. Oh, I put an extra zero on there. 8.1. And again, guys, I'm trying to adjust to try 8.5. 8.5. Boom. And we hit finally the minimum debt service requirement, 1.25x. So you can see here we went from 10.5 million to 8.5 million purely because the interest rate went up 2%. And this is what we saw over the last year roughly. We actually went up from like 3.5%, 4% rates on average. For commercial loans, I know residential people were going sub threes, and big institutions can get that, but we were going from 3 to 4% interest rates to now 6.5 to 7.5, upwards of 8% interest rates. So it's actually even worse than this. And this happened in 2021, 2022. This happened over the course of 1.5 years, which is the craziest interest rate increase we've ever seen. So when you see here that's the real reason why you're seeing low amount of commercial real estate transactions and prices drop. This isn't some crash where there's no metrics, people don't understand it. Everyone in the commercial real estate space understands this. This isn't something that's shocking to us. When we saw the rates go up, we're like, me as a broker, I'm like, this deal is going to fall apart. Finance is not going to happen. We're going to have to renegotiate, because we know that mathematically on paper, the returns aren't going to be able to cover the debt service, or it's not going to hit the returns that make sense for a buyer. Now we have to go talk to the sellers, try and get their expectations down. But of course, sellers like, well, I listed the property with you for me to get top value. Why are you not getting me the same price that guy got 6 months ago? And it's like, well, returns basis wise, I'm getting the buyer getting the same returns. But the thing is, when the interest rate's this much higher, that's out of our control. So we need to adjust accordingly. Sellers are stubborn, buyers are stubborn, and it's causing transactions to just not happen now. But that's just the typical adjustment to commercial real estate. Now, the biggest issue that we are running into, and this is how we can potentially be getting into a crash. So commercial real estate loans are on usually terms of 3, 5, 7, and 10 years. Okay, and what that means is, so regardless if a property is amortized over 30 years, so they'll do 25, let's say they do 20% down, just like a residential mortgage, and a 30-year amortization, just like a residential mortgage. That 30-year amortized loan for residential is usually going to be paid fully over the 30 years, and it's a 30-year term, so you don't have to pay it off until you're done at the end of 30 years. The way commercial real estate works is, even though it's a 30-year loan, they make it due in 10 years. Because the idea is you're supposed to increase the value of the property, and it appraises higher, then you do the total payoff at the end of whatever your term is. So anyone that bought a property, whether it was a 3-year loan, a 5-year loan, a 7-year loan, or 10-year loan, the 7 and 10 probably safe, 5 probably safe. Guys who got short term, anywhere from 1 to 3 year, whether it was a bridge loan, 1 to 2 year loans, or it was just like a 3-year term kind of loan, those guys who bought in, let's say 2019, 2020, their debt is coming due right now. And the thing is, with their debt coming due, their property might not be as valuable as they projected it out to be, because they weren't projecting interest rates to go up this crazy. So where there's potentially going to be a major market shift or some type of crash for you to potentially pick up properties at a cheap price, or properties going into foreclosure, is that as that debt's coming due and the property is not worth how much they owe to the bank's going to end up taking it back, unless they could just go do what's called a capital call and pay off the difference of that to keep the property. So like the only people that are really struggling right now are the ones that have debt coming due. And then obviously just operations people, if you have problems operating, and whether it's a good market, bad market, if you have operations, cash flow problems, that's just part of business in commercial real estate. But the things that are outside of people's control is that people who bought commercial real estate properties without accounting for the fact that interest rates might have went up, those might be going back to the bank now and foreclosing. But other than that, this whole price correction and lack of transactions, that is not a function of, oh, this is indicative of some crazy crash. That is just the typical market reactions based on financials and finances that people on YouTube just seem to not really understand about commercial real estate. So I want to just make this video for you guys to explain really how this truly works, and I hope this video was helpful. If you guys have any questions, comment below. If you guys want to learn how to find commercial real estate deals and make a living with no money, you don't need anything, just learn how you could make money learning how to find deals for investors. Or if you are a commercial real estate investor in any asset class of buying commercial real estate and you want to learn how to find deals direct to seller without having to go through a broker, download my free guide, CREDealAccelerator.com. Link is in bio. I do also have a coaching course platform as well. But thank you guys for watching. See you guys in the next video.